the limited liability company, or LLC. Now, an LLC is owned by its members, okay, which in a corporation would be stockholders or shareholders. Now, you can have one or more managers. You don't have to. When you set it up with the state, you file what's called an Articles of Organization or Certificate of Formation, depending on what state you're in. But generally, we call it an Articles of Organization. So you file with the state, you pay a fee, etc. You have members and managers. Now, if you set it up with just members, then it's like a general partnership, and then any member can transact business on behalf of the company. Members are not liable for what each other do. Managers, on the other hand, if you set it up to manage, then you have one or more managers who manage the company, and members who are not managers cannot transact business. Okay? Sort of like general and limited partners in that sense. That you have managers are like general partners, and non-managing members are like limited partners. Do managers need to be members? No. Typically, that's the way it is. It's husband and wife. Husband and wife can be managers and members. But it could be A, B, and C, and D is the manager. Doesn't have to be, manager does not have to be a member, but it typically is. And not all members have to be managers. Okay? And managers are like officers of a company. You know, they're not generally liable for things that they do on behalf of the company. Like signing an obligation, like a contract. They're signing as a representative capacity on behalf of the LLC. And members are generally not liable for things that go on in the company, like the company goes bankrupt, unless they signed a personal guarantee. Members are not liable. It's sort of like shareholders in a corporation. Okay? The company has what's called an operating agreement. And if you haven't done one of these, then you really should. Because the operating agreement spells out, especially if you have, co-members, we call them sometimes partners, but they're not really partners. It's not a partnership. But loosely, we'd say if you have partners, you should have an operating agreement, because the operating agreement, like the bylaws of a corporation, spell out, what are the roles and responsibilities of the members and managers, what happens if there's a disagreement, what happens if somebody dies, what happens if somebody goes bankrupt, what happens if somebody wants out of the company. All these things can be spelled out in an operating agreement. So if you were doing business on regularly, you wouldn't want to do a general partnership, you'd want to do an LLC, and then have an operating agreement in lieu of a partnership agreement. Because an operating agreement is like a partnership agreement, but it's not a partnership. Okay, but it spells out all the rights, rules, and responsibilities of the members and managers of the company. Okay? Now, here's where it gets a little sticky. For tax purposes, the LLC does not have a tax return. The IRS never made one. So there's 4 ways to get taxed. Now, there's default rules, and then there's what's called elections. So by default, a single member LLC, one member, is what is known as disregarded. What does that mean, disregarded? Well, like a land trust or a living trust, there's no tax ID, or you can get one if you want for banking purposes, but you don't need one. The member, the single member, is the taxpayer. So if you were a sole proprietorship and you did a single member LLC where you're the sole member, you would still file Schedule C. You wouldn't change your reporting because it's disregarded. Meaning the member is the one who reports the income and expenses. If you had rental properties and you were reporting on your Schedule E of your personal tax return, and you place those rentals into an LLC single member, it's disregarded, meaning you continue to report the same. This is what's often known as the lazy man's corporation. You get liability protection because under state law you're an entity, but for federal tax reporting, you're still reporting, vis-a-vis the entity. So especially if you have ordinary income, this is a bad way to go. So if you're filing Schedule C, you will continue filing Schedule C, which is not good. We already discussed that. If you're just starting a business and you want to be disregarded as an individual sole member, and you were having earned income like wholesales, flips, things like that, you'd end up on Schedule C again, which is not where you want to be. So this is generally a bad idea, with 3 exceptions that I'll go over in a moment. Okay? Now, the second way to do that is if you are a multiple member LLC, by default you are a partnership. And that means you file a partnership return. Again, it's not an LLC return, it's a partnership. Same as a general partnership, same as a limited partnership, same form, which is IRS Form 1065, and then each partner gets a Form K1. This is also a pass-through entity. Now, a single member LLC is not a pass-through, it's disregarded. A multiple member LLC files a partnership return, which is not disregarded, it files a return. Each member or partner gets a K1 showing his share of income or loss. And this is generally a good format for passive, like rental income, because you're not going to pay FICA tax on those earnings, and it's not going to be subject to the dealer rules we discussed earlier, which, again, ordinary flips and things like that, ordinary income you want to do in a corporation. Now, whether you are single member or multi-member, you can choose to be a C Corp for tax purposes or an S Corp for tax purposes. So, if you're going to do ordinary earned income activity, and if in real estate that would be like wholesales, assignments, flips, things like that, that would be subject to FICA tax, you want to do it in either an S or C Corp, probably an S if you're starting out, or an LLC taxed as a C or S Corp. It's 6 of one, half dozen of the other, and in reality, a lot of people do the LLC as S Corp election because you don't have to worry about bylaws and stock certificates and minutes. You just have an operating agreement, a filing with the state, and then an annual report with the state, and an S Corp return you're filing. So if you did an LLC as an S Corp, you would file an 1120S, and as a C Corp as an 1120. So most people who start out, as just a rule of thumb, in real estate, if they're going to be flipping and wholesaling, they use an LLC as an S Corp filing Form 1120S, which is kind of the best of both worlds: simplicity of an LLC, tax benefit of an S Corp. Now, for rental income, on the other hand, they go multi-member LLC filing as a partnership. And I'll explain why in just a moment. The exception to the LLC is so would you do an S Corp, or an LLC as an S Corp? It's 6 of one, half dozen of the other. It depends on which state you're in. Some states, S Corps are cheaper than LLCs. So like in Illinois is outrageously expensive for an LLC. It's like half the price. New York is another one. So in New York or Illinois, you'd go S Corp. And in most other states where the fees are comparable, you go LLC as S Corp for your ordinary income activities. Okay? A multi-member LLC as a partnership has better protection. Now, let me explain to you what I mean by that. If you have an LLC and you have member A and member B, and that could be husband and wife, by the way. And husband and wife can go partnership even though they're husband and wife. A and B. And let's say someone doesn't sue the company but sues A or B individually separate from all this, gets a judgment against A or B. Now, if this were a corporation, they can get to the stock, get in the back door, vote as a stockholder, A off the board of directors, fire the officers, and then liquidate the bank accounts through the back door. In an LLC, you can't do that. A creditor of an LLC in most states, some exceptions, but in most states, the only remedy creditor has is to get an assignment of the money. This is called a charging order. So what they get is, if there's distributions coming out of money to A, it would go to the creditor through a charging order. But, if B says, I vote not to distribute income, the creditor is not going to get very much, okay? Also, the charging order doesn't give the creditor any voting rights, so that they can't step in and say, I vote out B, and the managers, we're going to change and liquidate the assets. They don't get that. They get the assignment of the money rights only, not the voting rights. So this is what we call asset protection. A feature here of an LLC is that the creditor is limited in what they can get out of it. However, what if it's a single member LLC and there's only A? Can A say, you only get a charging order against my money and I still get to vote not to distribute income? Well, many courts have said, and state courts have said, no. Colorado was one, Florida was another, and recently I think it was Maryland who came to this. So the trend is single member LLCs don't give you this charging order protection, this limitation to creditors. That's why I said earlier, if you're going to buy and flip, a single member LLC as an S Corp is fine, because remember, you're just rolling profits through it and you're going to take all the money out and there'll be no accumulation of assets. Whereas an LLC where you're going to start accumulating money or houses, you want an A and B member, because with two members the charging order protection works. Okay? So what if you're just an individual, like you're just one person, you're not married, you have no partner? Could we make this, let's say, an S Corp? Yeah. Or a C Corp? Sure. Or an LLC as an S Corp? Yes. Any one of those would be fine. Even if this partner B was only 1% owner and A, which is you, is 99%, it's still a partnership. It still has two members, and therefore you have the limitation of the charging order protection. Okay? So the general rule of thumb is S Corp or LLC as S Corp, most people start out for wholesaling and flipping as their primary entity for that, formed in their own state. Whereas if you're going to hold properties, you want to do a different LLC as a partnership, and if you don't have a partner, stick in either your cousin as 1% or an S Corp that you form, that could be the other S Corp we just talked about, could be your partner in there just owning a small percentage, and that makes it a partnership. So that's a good way to go.